Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave "yes" in the comment, and we are here to help you obtain insight and build wealth. Have you ever heard the saying, "Money makes money"? Well, compound interest is the reason that's true. It's been called the eighth wonder of the world, and once you understand it, you'll see why many investors say, "Time in the market beats timing the market." Today, I'm going to break down how compound interest works, why it's so powerful, and how you can use it to grow your wealth, even if you start small. The simple idea. Let's start simple. Compound interest is basically earning interest on your interest. Here's the difference between simple interest and compound interest. Simple interest. You earn interest only on your original money, also called the principal. Compound interest. You earn interest on your original money plus any interest you've already earned. This creates a snowball effect. Your money keeps building on itself, and over time, it grows faster and faster. The snowball analogy. Imagine you roll a small snowball down a snowy hill. At first, it's tiny. But as it rolls, it picks up more snow. Eventually, it becomes huge. That's exactly how compound interest works with your money. In the early years, growth feels slow. But as time goes on, your money starts to grow at a much faster pace, even if you stop adding new money. Why time is the secret weapon? The single most important factor in compound interest isn't actually the interest rate, it's time. Let's compare two people. Alex starts investing $200 a month at age 20 and stops at 30. Jordan starts investing $200 a month at age 30 and keeps going until 60. Even though Jordan invests for 30 years, Alex ends up with more money at age 60. Why? Because Alex gave compound interest more time to work its magic. The earlier you start, the more time your money has to multiply. And that's why starting now is better than waiting for the perfect time. The rule of 72, a simple shortcut. I promised no complex math, but there's a super simple rule you can use, the rule of 72. Here's how it works. Take the number 72, divide it by your interest rate, and you'll get an estimate of how many years it takes for your money to double. Example. If your investments grow at 8% a year, 72 divided by 8 equals 9 years to double your money. It's not exact, but it's a quick way to visualize your growth. Real-life examples of compound interest. Let's say you invest $1,000 and add $100 every month, with an average return of 8% a year. After 5 years, around $8,000. After 10 years, around $18,000. After 20 years, around $55,000. After 30 years, over $135,000. You only invested about $37,000 of your own money. The rest is growth from compound interest. How to supercharge your compounding? If you want compound interest to work for you faster, there are a few key things you can do. 1. Start as early as possible. Even small amounts now can beat big amounts later because of time. 2. Be consistent. Invest a set amount every month. This is called dollar cost averaging. It removes emotion from investing and keeps you building wealth steadily. 3. Reinvest your earnings. Whether it's dividends from stocks, interest from bonds, or rent from real estate, reinvest your profits instead of spending them. 4. Minimize fees. High investment fees eat into your returns and slow compounding. Use low-cost index funds or ETFs. 5. Stay invested. Market ups and downs are normal. Pulling out during a downturn means you miss the recovery and the compounding that follows. The emotional side of compounding. Here's the tricky part. Compound interest doesn't feel exciting at first. In the first few years, growth is slow and almost invisible. Many people give up or spend their money too soon. But think of it like planting a tree. The first few years, it's small and doesn't give much shade. But as it grows, it becomes huge and unshakable, giving more returns every year. If you stay patient, your investments will eventually hit an acceleration point where they grow faster than you can contribute. Common mistakes to avoid. Even though compound interest is powerful, many people sabotage themselves. Here's what to watch out for. Starting too late. The later you start, the less time your money has to grow. Stopping contributions. Consistency is key. Withdrawing too early. Let your money stay in the game. Focusing only on high returns. Risky investments might give big gains short term but can also wipe out your principal. Ignoring inflation. Your returns need to beat inflation, or your money's value will shrink over time. Where to put your money to compound. Compound interest works best when your money is invested, not sitting in a low-interest savings account. Here are a few popular options. Stock market. Historically, stocks have returned around 7 to 10% a year over the long term. Index funds and ETFs, low-cost, diversified investments perfect for compounding. Dividend stocks. Reinvesting dividends can greatly speed up compounding. Real estate. Rental income plus property appreciation equals double compounding. Retirement accounts. Accounts like a 401k or IRA in the US, or RRSP in Canada, offer tax advantages that supercharge growth. The power of small starts. Many people think they need thousands to start investing, but compound interest works with any amount. If you invest just $5 a day, that's less than a coffee for two in many cities, at an average of 8% a year. In 10 years, around $27,000. In 20 years, around $66,000. In 30 years, around $190,000. Small steps, big results. Patience is profitable. One of the biggest lessons about compound interest is this. Your patience will be rewarded more than your skill at picking investments. Even professional investors agree, staying invested and letting time work is often more profitable than trying to outsmart the market. Action steps you can take today. If you want to take advantage of compound interest starting right now, here's what to do. Decide on an amount you can invest every month. Even if it's small, commit to it. Choose a simple investment, like a low-cost index fund or ETF. Set up automatic contributions, so you never forget to invest. Reinvest all earnings. Don't cash out dividends or interest. Leave it alone. Resist the urge to check it daily. Increase contributions as your income grows. Compounding plus higher contributions equals wealth acceleration. Compound interest isn't a get-rich-quick scheme. It's a get-rich-sure method, as long as you give it time. The best time to start was yesterday. The second best time is today. Even if you start small, the power of compounding will work for you if you just keep going. So, plant your financial tree today, water it consistently, and watch it grow into something massive over the years. Because the truth is, it's not about how much money you start with, it's about how much time you give it to grow.